morning, everyone. Welcome you joining today's Savor at Home and Learn. I'm Pauline Lam from Kota Realty, your 2020 Co-Chair Education Committee. Today's topic is understanding credit and optimizing your credit history. A few housekeeping tips. All participants will be muted. Should you have any question, please enter it into the chat box. Speaker will answer it during the Q&A section. This meeting is being recorded, so you can review it on our West San Gabriel Valley Realtors YouTube channel later. Now, I would like to welcome our committee member, Ms. Sylvia Rosish, to introduce our speaker today. Sylvia, take it away.
Thank you, Pauline. Good morning, everyone. This morning we have our very well-known Mario Manzanilla. He holds a BA in economics, mortgage loan officer, and reverse mortgage specialist with Rate 1 Financial. He's going to talk to us about how to build a perfect credit score and more information from what he has for us today. Okay, take it away, Mario.
Well, good morning, everybody. I hope that everybody gets my objective for today is for all of you to have the resources that you will know that it will impact you, your family, and actually your clients. You could become with this information at the end of this presentation, you will have the resources, all of you, to help your clients, again, yourselves. It's very impactful, and this is what I would hope to achieve. So with that in mind, there is a lot of information going. Let me start. Thank you so much for the introduction, Sylvia. It's a wonderful day. I'm glad for all of you to be here. So enjoy the presentation. And like Pauline said, this is being recorded, and so it will be as a reference. There will be some that you will want to refer back into some of the information here. So here we go. I am pressing enter, but somehow it's not working for the next slide. Let me see. I thought it would work.
Go ahead and click, Mario, go ahead and click on your PowerPoint and then you should be working.
Click
on your PowerPoint and now press enter.
Here we go. So here are the topics. Here are the topics. The real cost of not knowing about credit rules. We all involved, including ourselves, we're playing this game, but nobody has really taken the time or anything to really educate us there. And you will see a few things. What is the cost of that? Credit reporting agencies will be talking about that, credit reports, what is in a credit score, how do they determine credit scores, improving your credit. You will see how to improve and maximize it. There is no reason why everybody should be at 740 FICO score plus. There is really no reason. You will see why. It does take time sometimes, and it's like getting into shape. And lastly, I didn't put that there, how to protect your credit report from identity theft. I will be also disclosing the resources. Where do I get this information from very reliable resources, including the Federal Reserve. So there will be as we go along the presentation. So those are the topics that are required to be covered. So let's start with the real cost. So what are the real costs? Well, this is what happens. We're built in an instant gratification society. You don't have the cash right now. We want the latest electronic gadgets, new nice cell phones. You know, when Apple announces, you see the big lines and they're paying $1,200, $1,500 in phones. That's not a bad thing, but they're playing a lot of them with credit cards. They're being charging it, pay now, pay later. The question is, can they really afford it? Where do I get this information? By the way, there is an excellent book out there, and hopefully in the future, we'll get to see if I can get a hold of this speaker. If you see the source, Break Free, Take Control of Your Money Today for Better Tomorrow, written by Rod and Cheryl Kuratomi. Excellent book for anybody. It starts from the beginning to all the way to retirement. Does not have a lot of good examples. So I'm not promoting the book. I'm just showing you that hopefully we can get them in the future, hopefully to speak about this topic. The next thing, so what are the real costs of credit? as we know, it's a game. It's a game that we play. It's like playing baseball, any sports. The problem is nobody tells us the rules. So if you go and play a major sport and you don't know the rules, you know what could happen, right? You don't achieve much. That's what's happening to everybody. You will see what I mean very clearly as we go along. The other thing is there's a lot of lack of consumer information. There is not education available out there. And on top of that, there is misinformation out there. So you have this combination of these items about credit, which impacts us from anything that we buy. I mean, from cars to leases to, if you're a landlord, you know what you're looking for when you're getting your tenant. If you're doing anything almost is credit cards, anything that you're going to apply and that when you need credit, there you are. You know, we're playing this game. So according to the Consumer Federation, there was a survey done. They said if we get 30-point increase, everybody gets 30-point increase in credit scores, we should be able to save over $20 billion. Can you imagine? That's a chunk of money, $20 billion, just a 30-point spread if everybody were to go in that route. So where do I, by the way, let me give credit to where I got this information. You can see the at the bottom, most of this information came from 3 sources. A little bit from the Break Free from Mrs. Kurutami, and then the Nabil Kaptan and Craig Watts, who is the Public Affairs Director of FICO. That's where I got this information. Some of it I didn't even know myself, some of this stuff, but it is the core of the information that you will need to know for anybody, for you, your clients, and everybody. So you can see that there's a lot of costs for not knowing what this game is about. So let's move to the next part. So what is credit rating? Well, how much you borrow, from whom you borrow, how do you repay your debts, how do you handle your debts? It's just that basic. So then here's the real cost of credit. Suppose that you have 2 couples and one of them has a 580 credit score. We're gonna be really going into in depth, so you will see the cost of this. And the other one has 740 credit score. So they have the identical debt. The only thing that I didn't put on this table was the interest rates and the payments, because otherwise we'll have a huge table. But in the bottom, I would say this again came from the Nabil Kaptan's information. So both of them have the identical debt. But look what happens, $250,000 mortgage credit, same, $16,000 on revolving credit, car payments, the same, student loans, the same. There is a difference between the 580 score and the 740. It came down to $1,344 a month difference in payment. When you amount that in a year, that's $16,128. And if you put that into 5 years, that's $80,000. That's a lot of money, just for having a difference in credit scores. Can you guys see that? So guess what happens when they want to buy a home, right? What do you think? Or if you're a landlord, who would you rent the property to? The one at 700 or the one at 580? You see what's happening here now? And there is a huge cost, and we don't know. People take it for granted. Oh, well, heck, I'll pay 17%. That's normal. No, the guy at 740 is probably paying 5. You see what I mean? So that's the real cost of credit. If we don't kind of acknowledge it because we don't really know about this, but when you start knowing this, you're going, oh, wow, this is costing me. So then the next thing, what is the importance of good credit? Well, obviously, lower interest rates. We already know that. A lot of you, I know that I'm primarily speaking to realtors. Some of you ask me, including clients, what's your rate today? I should really say, what's your FICO score? Because I know if they are 580, they're not gonna get the rate that is being even advertised. You see, about to get a job. And it really affects many, many, many things. To lease a property, if you're a landlord, who would you rather lease to, right? Establish utility and even obtain insurance. I don't know if obtaining insurance, there was a dilemma about a couple of years ago. I remember even at the board, we had some, the outage was, the comments were, if you have bad credit scores, there's a better chance for you to get into a car accident. Can you imagine? Because you're pressured And so guess what? Even insurances. Now, there was a law, there was a big dilemma about that, and I'm not sure if it went through, but that's something that the other four, I do know for a fact that this importance to having a good credit. So moving on to the next step. This I got from the Federal Reserve, and I will provide all of this information so you will have the same, this for you, your clients. So what is a credit report? Well, basically it's a report your history, will have your identity, your name, your address, date of birth, your existing credit accounts, mortgage loans, car loans, public records, and inquiries. That's your credit report, you see? So where does these bureaus get their information? So your creditors, such as the banks, they get it from the banks, credit cards, auto finance, anybody that you sign in to get credit, that's where they get their information, plus the public records. Now, it's very interesting. Notice how I put on the comment at the bottom, I put a few stars. Each credit bureau gets information from different sources. Now, what that happens, I don't know if you have seen when you pull out your 3 credit scores, they're different, right? 680, 720, and the other one is 700. And the question is, okay, why? Because the information, not every bureau reports to the same, all of the bureaus, not the 3. So the sources come from different sources. So one, for example, a Chase credit card, I'm using that as, may only report to Credit Equifax, and the other 2 don't get reported. You see what's happening here? So the information may not be the same from one credit bureau to another. So understand that why you have 3 types of credit scores. The information is not the same on each one of the scores. So the next thing is, and don't worry about this one, I put this one there because now it's very easy to dispute accounts, and I'm going to show you a few things of how to improve your credit report if you happen to be there. And this is just the credit reporting agencies. We know that the 3 main ones are Experian, TransUnion, and Equifax. And this, by the way, as I said, is being recorded. You will have this so you can actually contact them directly if you need help on any of these matters. So the next thing is, what are the types of credit reports? This is another kind of interesting information. There's consumer credit reports out there. So what does that mean? What is a consumer credit report? Well, you know, credit agencies, those 3 bureaus that I just mentioned, you know what their purpose is to sell information. They make millions of dollars selling information, your information, my information. And on top of that, they sell you, oh, if we want to protect your credit reports, sign up and you pay a monthly fee and we'll monitor your credit. You don't need that. I can tell you that right now. Don't even get into that. But so people go there, they pay those fees, you know, auto clubs, everybody promotes those, and you will see it. I tried it and I'll show it to you in a little bit. Those guys, everybody pulls a credit and they get a credit score. Well, that's considered a FICO score. It's not a FICO score. It means it's not valid for mortgage purposes. You see what I mean? So people say, well, that's a consumer credit report, but it's not used for mortgage underwriting. So I just want to make that clear. So if you get those personal credit reports that you get anywhere, they're not going to be counted as to be used for anything, decision-making, for anything, cars or anything like that. It's just for you. Okay, my recommendation is I'll give you some tips on that and how to actually do this, so you don't get into, you don't need to get any of those pay any of those fees per month or anything. You will know exactly how to get your credit report and monitor anything that you need. In-file credit report, those are the ones pulled by organizations such as the nonprofits and some of that they don't affect your credit report at all. And obviously the residential mortgage credit report, those are the ones that we all use, all banks, institutions, they use that that pulls out the FICO scores. So just keep that in mind, that there are types of credit reports, and that the one that you will need for mortgages specifically is the ones that the lenders use. So the other thing is, and I went to this, I'm a little advanced ahead of the game. So when you get your credit report, what do you want to review? Obviously, you want to make sure that your name, everything is correct, your credit information, your public records, because if something appears, if you never had a bankruptcy, because your name is similar to somebody, right? To say, I'm Joe Montes or Joe Jose Montes, and the other guy is Jose Montes, and this guy had a bankruptcy and now it's on your credit report, which those things do happen. There are ways to correct that. So that's why you need to check your credit reports. Inquiries are very minor. We're gonna go in detail a little bit more about that. Okay, so this is what you do when you look at your credit report. You look for this type of information. So the next thing is, what types of accounts are there? Well, there's individual account. If I go by myself and I apply for a credit card, well, and if you're married, it's okay. So now at that point, that's only me. But it could be husband and wife, and also authorized user. Say, for example, I'm the father, and my 16-year-old kid needs an 18-year-old kid just going to go to college. I say, well, I want a credit card. No, I'll put you as authorized users on my credit. So you call that company and it says, I want to put my son in there. You sign son. Now he's an authorized. He has the exact same. Your credit limit is under your credit, but he's also he's establishing his credit, right? So now you see what an authorized user is. Joint accounts, be careful. Husband and wives, it's always great. I always say that. But here's the thing, the trick about that. If they go through a divorce, this has happened in my own experience. I have seen in not thousands, but many times. They go through a divorce, judge says, husband is gonna pay the balances on this credit, right? And then, so the wife says, okay, or it could be vice versa, right? I'm not trying. So then the wife says, basically says, oh, okay, well, he's gonna pay all of that. That's what the judge says. Husband finds a girlfriend, moves to Arizona, goes out, never pays those. Who gets affected? Both. Damages the credit report of both. So this is when the things come and they come to us and goes, hey, wait a minute, the judge told me he's supposed to be paying, but he didn't. We, the lenders, we do not fix credit reports. It's something that you have to be dealing with those persons, not because the judge said it, it's have to be dealing directly with those vendors that you sign up with, you see? And then the open 30-day, that used to be American Express. I don't know if they do it anymore. You get your balance, you pay it at the end of the 30 days, that kind of thing. So installment accounts is basically your car loans, you know, they don't change. Mortgage loans, they don't change. Revolving, your lines of credit, credit cards, and the open 30-day, I already went ahead and told you, they rarely exist, but they are there. I just want to make sure that you understand this type of responsibilities and types of accounts. So here's one that people always say, we talk FICO, FICO, FICO. What is FICO actually? So this is what really happened. Bill Fair is an engineer. A while back ago, and Errol Issac created a company. This is called Fair Issac Company, otherwise known as FICO. So now you know where FICO comes from, Fair Issac Company, and happened to be an engineer and a mathematician. Errol Issac was a mathematician, or is, I'm not sure if he's still alive. So they created also the model. We're gonna get deep into the model. So the model, this FICO score model, predicts your risk and credit worthiness. So when you get a score, what they're basically saying to you, remember the 740 and the 580, who is actually at a higher risk of not making the payments? You see what I'm saying? And your credit worthiness. If you're a 580 credit score and you go and apply for a credit or you want a mortgage, are you a high risk? Are you worth it to get even a $500,000 loan? Can you see what's happening here? That's how they perceived it. So you have to be really careful about, obviously, this is the reason why you need to monitor, and I will explain exactly all of that in very detail coming up. But I wanted you to know so now you know when they say FICO, you know Bill Fair, Errol Issac, two combined people, engineer and a mathematician, created a company, created the model. So credit scores, let's start getting that a little deeper here. Credit scores usually, and have to, range between 300 and 850. There is no such thing as 906. Some institutions, this is the misinformation out there. They're saying, oh, well, there is a 300 to 900 or 350 to 950 or something. No. It's 3 to 850. Those are the real credit scores. Okay, I just wanted to make that as a point. So the next thing, what makes up your FICO score model? What makes it up? Number one, 35% of your score. Can you imagine this? 35 is payment history. We're gonna go in details in depth, a little bit more in depth. But this is the model, okay? Number two, amount of outstanding debt. You heard of the term maxed out, right? We're gonna go into detail. Well, how does this affect your credit? This is what starts the thing. This is the model that this guy's created. Number three, the length of history. How long have you had that history? Okay, we're gonna go into detail again. Types of credit, that's 10%. And new credit, that's 10%. So you see, this is how this model will work. And each one of them has a specific ways to affect your credit. And let me start going into a little bit more in depth on what that means. So 35% of your credit score. A recent 30-day late comparison. Suppose that, now people are in the COVID-19, a lot of people may be out of employment, and you have perfect credit history throughout all of your life, basically. And last month, you couldn't make a couple of payments. So that will have a drastic effect on your credit report. A recent 30-day late is worse than a bankruptcy 5 years ago. So this is what will happen. And this, I actually got this information again from Mr. Captain and this. If you have a person with a 680 credit score, just by a 30-day late, a recent one, say 2 months ago or a month ago, it will drop 60 to 80 points. And if you have a 780 FICO score, you see what happens? Even worse, 90 to 110 point drop just for a 30-day late. So the higher the score, if you notice the 780 FICO score, the worse the negative point drops is. That's kind of a crazy thing, but that's not, I didn't design the model there, see? So you have to be careful about even a 30-day late on this. And I will show you how to avoid this if you get into a financial trouble, as we're doing COVID-19, and your clients may need some assistance in paying debts and to avoid this type of effects. So here's another thing, and I already gave you a little bit of synopsis. An older negative account have less negative impact on your credit score, effect on your credit score. So a bankruptcy 5 years ago and a 30-day late, which one will have a negative, worse negative score? The 30-day late, the recent one, that a bankruptcy 5 years ago. That's really what that means, you see? So, and if you look at a bankruptcy comparison of two people, look what will happen. A 680 credit score, you have 130 to 150 point drop. And if you're a 780, you see the higher the score, then the worse the point drop, 220 to 400. That's damaging. I mean, if you're a 780 and you get to a bankruptcy situation, you're gonna go down 220 point drop rather fast, Now keep in mind that this kind of scores, they change rapidly too. They move along, they don't stay there forever. It's like getting in shape. And I'm gonna show you how to actually counter some of this type of situations. So the bottom line is, the higher the score, like you saw this, you're a 780, you're gonna drop more points than somebody that is a 680. And the older negative accounts have less weight than on your credit scores. So if they're already old, they have less weight on your credit scores. The older they are, and negative credit I'm talking about, they have less weight on your credit scores. So be careful about those recent 30-day lates. I get clients sometimes, I always have for the last 10 years, always pay on time. Due to COVID-19, now I couldn't pay. And now look at this, the damage on this. Now they want to get a loan. That becomes problematic, you see? So the FICO, the next one, that's the 30%. the amount of outstanding debt. This one is an incredible one. The other one is rather easy. You pay on time. That's basically what that's all about, right? This one is the most, I think in my experience has been the most confusing. The amount of debt, you hear the terms maxed out and all of this stuff. Well, what does that really mean? How do they determine what is maxed out? Well, and that affects 30% of your score. It's a big chunk. Basically, they call this utilization ratio, and you will see what that means. The lower the utilization ratio, the better you are. You will see what that means. I will give you an example in the next one. So I'm keeping this thing simple, and actually this thing came exactly from the sources that I got, exactly the same scenario. And there's something that you may want to keep in mind here. Suppose that you have 4 credit cards, right? All at 10,000. That's your highest credit limit, right? When you go and apply, they all give you a credit limit. This is your high. In this case, I use 10,000 for each. So you went ahead and each one you borrow 2,000. Well, you divide the amount you owe, which is 2,000, and you divide it by the credit limit, which is 10,000, and there is your 20%. That's your utilization rate. Now, you can do it on anything. Or if you have a 5,000 credit limit and you $1,000, well, you divide 1,000 into 5,000. There is your utilization ratio. So the utilization ratio, it's the lower that it is, the higher the credit score. So here's this is one of the key things here. Suppose that now this person here says, well, gee, I got an offer at $10,000 and I want to pay those 2,000, 2,000, 2,000. I'm tired of putting 4 bills per month on each one of those credits. So you get that credit at 10,000. As you see that number 6 there, you open a new one and you consolidate the accounts. You pay them off. And at that point, what do you think is going to happen to your credit score? It's actually going to go lower, because what will happen, you basically knock down the 20% utilization ratio, which is low. Now you have 0 utilization ratio of those 4. And on the other one, you got the 8,000 to pay those, but now you're at 80% utilization ratio. You see what happens? And and by the way, this makes sense to the consumer. Makes sense to me. Had I not known the rules, I would do the same. I'm saying, well, gee, hey, I got this one at 0% for the next year. I'll knock it down. But in the meantime, you just knock down your credit score. And hopefully you don't want to go and get a mortgage, because then it's going to have some decrease in points. Furthermore, some people do even worse. They say, well, you know what? I don't want those 4 credit accounts. I'm tired of them. You see the age there, 15 years, 12 years, 8 years, 5 years. Well, that's already 40 years of established credit that you have had, and you show good credit on those accounts. And if you go and close those accounts, you just knock down 40 years of history, and now you even made it worse, which makes it, you will see the next, now you knock down that history and you maximize your 80% utilization ratio. That's going to damage your score. You're talking 30 to 40%. That becomes very, very, very damaging. What will I do if I were in a situation like that and I want to pay these people off, and I don't? So first of all, I will not close the accounts. That would be one, because I want to keep the history, right? The longer the history, which is the next slide, the better. And even though you may decrease a little bit because now you have 80% usage, that's fine. Over time, you start paying it off and it will be fine. Okay, time works for you, not against you. Okay, so here's the other portion of this. What happens if you go and borrow more into this? Instead of, your credit limit utilization is you're at 10,000, but now you're at 60%. You borrow 6,000 on each one instead of 2,000. You are now at 60% utilization ratio. Now let me give you a clue here to keep in mind. When you open a credit line, unless you really, really need do not go above 20, 30% utilization ratio. In other words, if you're at 10,000, 3,000, just keep it within that range. Once you start getting on the 40, 50, 60, above the 50, you start seeing that starts decreasing your credit scores. You see what is happening there? Yes.
Just wanted to let you know you're already at 11:32.
Oh, okay. Thank you, Sylvia. So I'm moving on. So length of history, we already discussed that. That's why I'm moving a little faster. Those are the years that you have. You don't want to knock out the years that you have had on your credit scores, because then you're now simply, a lot of people have no, they start knocking down their own history just by, like I just mentioned in that example. You see how crucial that example, and that's 30, and then you add the length of history. If you look at the model, that's 10%, now just 40% of your credit history that is being involved into how we operate. The public does not know this, right? That's exactly what I mean. If the public wouldn't know this type of information, then they will say, oh my gosh, no, I'm not gonna close my credit. They obviously strategize to not damage their own credit history. That's the misinformation that is out there, or the lack of information that it is out there. And that's what I say, we're all playing the game, but we don't know the rules, right? This is the FICO rules. And so that's why I wanted to address those important, very, very important issues, which we are paying a price. You saw the cost of all of that. So it has a price. And types of new credit, this is back to the model. Opening several credits account at the same time will impact your credit score, especially if you have a high utilization. Say you are 80% on those 4 credit cards, so you have 10, you're using $8,000 on the 10,000 amounts. So what's happening here is you go and apply to a Chase credit card, and then they say, well, they probably most likely will not accept it. You just became high risk because you have too many utilization and you became a high risk. It's all about risk. So the credit model does understand you're shopping for a rate for a home. And what that means is if you shop, you go to several lenders, if you do that within a 45-day window of time, it will only count as 1 inquiry. But inquiries do not really do a lot of damage on your credit report, okay? But I just want to let you know that if you have clients that are looking for a mortgage or looking for a car, and they're shopping to see who's got the best rates or what have you, to be done within a 45-day period, so it will only count as 1 inquiry. You see, instead of having many throughout the time, which will impact your credit report, although not that as damaging as the other situations that we saw. Then, here are some of the credit problems that we see, right? You pull out a credit, there's a pattern of late payments, bankruptcies, judgments, charge-off, foreclosures. This is the kind of stuff that occasionally we see in our credit reports. And you can see obviously the impact that it causes, particularly when they're going to buy a home or something like that, it will have an impact. So how long does the information runs on your credit, stays on your credit report? Here you go. Negative information, 7 years. Bankruptcies, 10 years. Actually 7 to 10 years, depending on what kind of bankruptcy, okay? Judgments, 7 years. Student loans, 7 years. Inquiries, 2 years. So you can see they stay there for quite some time. But remember, the older they are, even if it's negative BK, it starts getting less and less impact on your credit report. So generally the period runs from the date of the last transaction. So that's when they, here are some things that people do. Oh, well, if I pay my collection accounts, will that impact my credit report? Initially it will, but over time it will get better. So we'll talk a little bit about fixing credit, what to do, which here we are. How to fix your credit reports. Step number 1, and this information, please keep that for your own files. And this, by the way, does not cost anything. The FACTA law of 2003, I believe, came up. And what it does is that everybody, including myself, everybody has the access to annualcreditreport.com. That's the database that you want your free annual credit report. I just recently, actually the other day, I went in there and checked it out to make sure that it's still yes. Be careful also. This one is the official one, but because also Equifax, TransUnion, and that, they're gonna try to sell you the products to monitor. No, no, no. Don't get into that. You just simply get your credit report. Why do you want that? That's your step number one. So you know, so you can review what is being said about you, so you can spot the errors right off the bat. Particularly if you have a home buyer or somebody that it is thinking about buying a home. Instead of waiting to the last second and when the lender runs your credit report, you already, you know, it's like the X-ray of the transaction. You already see, oh my gosh, this guy has a broken bones. You can prevent that, you see, just by getting there. And you can help your clients. Now you become, and you don't have to get involved. My recommendation, do not get involved because this is very time consuming, but they can have access to that. And they maybe you can coach them a little bit about the credit and stuff. Annual credit report will not give you the credit scores. That's okay. You know, if they want the actual credit score, myfico.com. That's the only one, no other one. myfico.com, right? That's the only one. So the first step, get your credit report and see. Remember what I said on a previous slide? I said, review that information. What is being said about you? Is everything correct? Your name, you know, because if you have a bankruptcy and it's not even you, okay? So you analyze it, you review it. Now, how do you dispute credit information? I will get a little bit into that. This is another key website. Look at the one, federalreserve.gov/credit reports. Actually, some of the information that I'm presenting, I got it from there. Like, what does the credit report? Your client or anybody, you can experiment that for yourself. You can do that after this meeting. Go to that federalreserve.gov and /credit reports. You will see it starts giving you the information, so you don't have to lecture your clients. They see it right from the Federal Reserve. If you want to dispute, you can actually do it online. You scroll down, and I think it's like on page 4, and then you scroll, and it gives you those websites, and you go right directly to the credit bureau and then dispute it. Has to be done in writing, no phone calls to the credit bureaus, okay? Now, when you do dispute any of this credit information, that is, my recommendations for you or to your clients, keep it very brief. You say, look, you need to put the reference for the credit report that it came from. That's why you need your annual credit report. It came from this, and I noticed that my account, it has this, and you put the account number. This is inaccurate and incorrect information. Please correct and send me a copy of my credit report. You're forcing them to investigate, and then and if they cannot they cannot prove it, or there's no response from a collection account or something, they must delete it within 30 days. It will happen in 30 days. You see how this works? You may have to do it twice, but you have that access. So keep this two, annual credit report and that Federal Reserve. You can offer that to your clients. Look, you know, if they have great credit, no big deal. You know, but if they have some stuff, there you are. Those are the two. And there is no cost to it. None of this has any cost, okay? So how do you improve your credit scores? Well, you correct the inaccurate information. You pay your bills on time. You minimize your outstanding debt. You open new accounts only if needed. Manage credit accounts responsible. Here's another thing I would suggest to you, to be real careful, and realtors may want to tell this to your clients. When they're going through a mortgage process, they got approved, okay? And they will say something, okay, wow, I got approved, I'm happy, we're all happy, everybody's jumping up and down. And this has happened, not to me, but I have heard of a couple of cases. They came to me because they run into this situation. The client of this realtor thought because they were approved, they were not informed, they went and bought $20,000 worth of furniture to for their new home. Well, guess what? That went into their credit report, affected their debt to income ratios, and now they didn't qualify. So this realtor comes up to me, I'm in a problem. They were almost crying. I'm in a problem. They were approved, but now they're saying, because the lenders will always check your credit report at the beginning and towards the end. They're gonna look to see if you increase your debts, you did something, you have a late payment within that time frame, whatever is 45-day, 30-day escrow. So be careful. You tell your clients, do not. We always tell our clients, and I'm sure our affiliate members, loan officers, say, don't, just keep your credit as it is. Don't make any major drastic, start getting new accounts, go buy furniture. If you're gonna do that, buy a new car, co-sign with somebody. You're gonna do that, do it after you get your keys. Don't do it. So please, please, all of you realtors, because then this becomes problematic and jeopardizes a transaction. So you guys understand that, right? So improving your credit scores. Suppose that you have bankruptcies, foreclosures, all of this. Nobody is going to want to give you credit. You go and it says, okay, it takes time. It's sort of like, oh my gosh, I'm 350 pounds, I'm 5'4", I need to lose weight. Obviously, it's going to take time. It's not going to happen over 2 days, right? So, but the time is on your side. Keep in mind, now, if you're going to buy a home and you put them into escrow, and now the lender says, oh gosh, you got a bankruptcy. Well, FHA does allow up to 2 years, after 2 years, but most of the conventional loans, 5 years, you know, and to have that after a bankruptcy to even be accepted, right? And same thing, kind of same situations with some foreclosures. They have little time frames, but roughly like that. So keep in mind, credit does not last forever. That's the encouragement that we have to give your clients. And it keeps changing consistently because they keep reporting every month, every so often, even more than once a month. So here's what I would do if I were you to be, nobody's giving you credit. Consider opening 2 or 3 secure credit cards. Now, where do I get those? Honestly, I had done research. I used to be a hard approved counselor, and I said, go to the credit unions. They offer those. Now, they say, well, secure credit card is my own money. Yes, your own money as collateral. They will tell you this, you need $500. You open 2 or 3 in different ones, but make sure, they said, if I open one of those, do you report to the bureaus? Because really what you're doing is building credits, building your credit, right? Now, when you do that, suppose that you have $1,000 credit limit. Make sure that you don't, now that you know the rules, don't go beyond 20% utilization ratio, right? Means don't go and borrow $800 because now it's going to diminish, it's going to, you see how the rules start coming in together? You keep it at 20%. Okay, I put $1,000, I'm only going to borrow, use it for your basic stuff if you need to. And then guess what's happened? Within 6 months, you're going to start seeing your credit scores improving rapidly. Okay, so keep in mind that's a solution for when you have very damaged credit. Now, here's another one. This is another piece of information that you want for your clients. If you know, especially right now, some of them are losing their jobs or they're having a hard time making their payments or what have you, right? If you know of somebody like this in that particular situation, you want to protect them, give them this website. This one is a nonprofit organization. It's a national organization. It's the National Foundation of Credit Counseling, NFCC. Here's the phone number and that. I Googled them, and you can Google them yourself. And what happens is, they will assign you to a counselor, and that counselor says, look, this is my problem. I lost my job, I can't pay. Let them, they'll guide you, they negotiate, they will do things to protect, to help you during these times. And even if not during these times, but anytime, you know, it could be after the COVID-19, everybody's doing fine, but if they have problems, this is where I would say, go and call these guys or Google in. They will assign you to somebody, because if you start getting involved trying to solve those problems, it's going to be extremely time consuming. Let these professionals, what's the cost? Nothing. I'm sorry, I shouldn't say nothing. 10 or 20 bucks to have that. You see what I mean? It's extremely, very, very affordable. They're not, these are nonprofit organizations. So that's my record. So now you have tools, 3 main tools, annualcreditreport.com, Federal Reserve federalreserve.gov / credit reports. You will see that. You can, after this presentation, you can Google them. You start seeing some of this information. You can Google this one, the national. So these are resources that you can, for yourselves, your family, your clients. You see what I mean? If you start seeing that they're having very deep type of problems, these are the people to contact. Protecting your identity, which is the last part. They will try to sell you, but incidentally, when you go to those websites, I already did, they're gonna try to sell you, oh, we can protect your credit. No. Here's the thing, the best defense, I learned this from Craig White, the documentary that Mr. Craig Watts did with Nabi Kaptan. And Craig Watts is the public affairs director of FICO. The best protection that you have is do a credit freeze. Now, here's what happens. Why do you think that the bureaus do not want you to do a credit freeze or promote this? Because if you have a credit freeze, nobody accesses your credit report. They cannot sell anything, right? And then they lose a lot of money, millions of dollars. So that's why this is kind of like the secret that you have out there. So basically, you can actually do it through the federalreserve.gov credit report. Now, what happens is, I had a client, I finished, she had a credit freeze because a few years back, she had identity theft. She froze her credit. Nobody touches it. You're in control of it. They don't sell that information. So then what happens is, okay, now we need to run a mortgage. Well, all she needs to do is contact the credit bureaus, or they said contact them, unfreeze it for 3 days, right? And then let the mortgage people, or you tell them the amount of time that you wanted to unfreeze it to. And then they'll say it, and then they'll freeze it back. But you're always protecting, so nobody gets, so credit freeze is a very important tool to protect you from identity theft. Very simple tool, free, you see? This is the information, crucial information, and I'm glad that this is, because you want these tools so you can present that to your clients and says, look, if you got, oh, do this or do that, or you can recommend them to go to those websites before they go to the lenders, before it becomes costly for them to go. So this is my final slide, and there's one more. Common credit myths out there. You hear it. If I co-sign, my credit will not be affected. He's making the payments, or she's making the payments. False. It will affect it. And in fact, it will put both of the debts into both of the credit reports. You see what happens here? But some people, I have heard it from clients, I'm co-signing, I have nothing to do, I'm just signing. Well, when you're signing, you're just as much as responsible as the other person. That's co-signing. Whether it's a mortgage, car loan, anything that is credit, even a credit card. You're saying to them, I'm just as responsible. If that person doesn't pay, I'm responsible too. That's a co-signer, okay? The bureaus will automatically remove your bad negative credit reports. False. You need to, once in a while, it's not the DMV. You know, these guys are for-profit organizations. So what you need to do is every so often, check your credit report at least once a year, and annualcreditreport.com. Don't pay anything. You know, if you want to do the myfico.com, yes, there might be a little fee there. But what you need to do is, once you look at that, then if you go over, I have seen credit reports with a bankruptcies that have been there over 15 years. And it says, well, this wasn't supposed to be there. Well, that person should have already pulled that out and dispute it. So just go there and says, this bankruptcy is inaccurate, and let them investigate. They will see it, you see, because a lot of times they don't have time to these are the errors that they commit. And a lot of errors are committed sometimes in names, social security numbers. This is bound to happen, okay? I already explained the consolidation of the 4 accounts into one, you know, and then you diminish your credit history and decrease your credit scores. So in essence, now you have these tools here that you can use for you, your family, and you can recommend them as they come along before they even go to a lender. So if you have you know, can I tell you something? Your client will tell you, I have some problems. You can say, look, pull out your credit report, annualcreditreport.com. Let's look at what you have. and then you can guide them through these websites so they can help them to themselves. They will learn, and if they need more help, the NFCC can help them, and you're basically helping them to get into their next step, home ownership or whatever they need. Okay, so lastly, this is a final thought, and actually I got this from a book called The Game of Life, How to Play It, The Way of Abundance. The way of abundance is a one-way street. The old saying is, there are no two ways about it. You're either heading for lack or heading for abundance. The man with a rich consciousness and the man with a poor consciousness are not walking on the same mental street. So the point to all of this, right? We have a lot of control that we can do. It takes a little bit of discipline, takes a little bit of that, but we have that. So we either decide whether we're going to be paying thousands of dollars. You saw $20 billion, or even paying like that guy for 580 FICO score versus the 740 FICO score, paying $1,300 a month. That's $80,000 in 5 years. That's a lot of money. I don't know about you. That's a down payment for a home or an investment property or retirement. That's a lot of money to pay for not knowing these rules. So with that in mind, I really thank you. If there are any questions, I hope that were answered throughout this process, through, with the examples. You have the resources. This is being recorded, and you can help yourself, your clients, check it out for yourself, pull out your own credit report and see what's being told. I use those tools myself. So with that, I really want to thank you. And Sylvia, I don't know if we're on time, if there is time for Q&A.
We are on time, and there isn't any question. There was a question, and the question was canceled. So you answered it.
Wow.
So everybody's good.
So everybody's good. So I thought it would be, because this examples, like I said, they were, again, this information, I got it from professional sources. And I put down what is the crucial information and the resources for all of us, particularly our group, to have. So you can, use it for yourselves, your family, because you hear, sometimes your own families will come along, oh, my credit, you know what? If you start getting involved and all of that, trust me, I've been there, done that. I used to get involved in trying to solve these credit issues, extremely time consuming. As we will take days, and then they'll tell you their stories, why this happened and stuff. Have a professional counselor from the NFCC help them out. Yes.
There is one question. Normally, how long the credit can be improved? Basically, how long would it take to get it improved?
It really depends on how bad the credit is, right? Somebody with a foreclosure, bankruptcy, or all of that. But typically, if you start doing, like, you start establishing your credit, the secure credit, and start building it up little by little, right? I would say within less than a year's time, you start seeing improvements. And remember, not by having the secure credit card, but keep in mind the utilization ratio. Don't go and bump up or if you have credit cards right now, right? Don't bump it up to 80% usage, because it's gonna decrease your credit scores, you see? And that's part of why we become the educators helping our clients into don't go and buy furniture, $20,000 worth of furniture, even though you've been approved. That's a must for all of you to tell your clients, because they will check it again and you increase your debt. And then if they make the money, fine. But if they don't, that could jeopardize their mortgage. You see, so this is the kind of stuff that we see all the time. And then the realtors not understanding this, or I shouldn't say the realtors, people don't understand in this. I always paid on time, and now this, and I can't buy a home, and then the realtor gets upset. He goes, well, how can it's already too late. It's like going to the doctor with the x-ray. Like I said, gee, you already have a bullet on your leg. Now you have to pull it out, right? We don't want that. We want to, because remember, once they're going already to, no matter whether it's a mortgage, a car, they're going to say, let me pull out your credit. Guess what they're going to look at? Exactly those things, the model. And they're going to, and what is the credit scores? Is the risk. Are you credit worthiness? Should I give you this loan? That's really the mentality that it is out there, you see? So it does take about 6 to 8 months.
One more question. How much FICO score will be decreased for hard pull of credit? And just a reminder, it's 1156.
Okay, for hard pull, it really, so you're talking what they call inquiries, right? If you look at the model, they go back to the model, an inquiry really doesn't affect much of your credit score. I would not be worrying about inquiry. What it makes you worrisome if you go, you start applying to different stores, different places all at once, or if you're already maxed out, right? Say, for example, all your credit cards are at 80, 60, 70% utilization, and now you're getting more inquiries. You see, that's what I'm saying, depends. Because then you get more inquiries to get more credit, thinking, well, gee, I'm paying on time, but you're at 70% utilization. Let me apply to Kohl's store now. You know, guess what? You might get declined. So you have to be careful about when you look at your credit, look at the utilization, you know, protect that. You see, it's a whole thing. This is the whole model that they use. So it's not a one answer because it will all depend on what is on your credit report. See?
Thank you,
That's why
Mario.
it's so important to pull it out.
Thank you very much, Mario, for all the information. And a reminder to everyone, the meeting is being recorded. We all will get a copy of it. And here's Pauline back in the screen. Take it away, Pauline.
Thank you so much. Thank you, Sylvia. And thank you, Mario. This is so wonderful and detailed informative presentation for us to really learn what is a credit score and how do you build up, and when you have the problem, how can you correct, right? It's
Yes.
so wonderful. Thank you again. And we really appreciate this wonderful moment with all of you, especially outside with the bad air, and the inside we got very healthy and fruitful and seminar today. Before the meeting adjourned, I would like to remind you the upcoming classes pretty good, all for you, present by Education Committee. First one, next Monday, 10:30, home inspection by Tony Escamilla. And Tuesday, 11 o'clock, very important, Living Trust by Attorney Benjamin Alley will come to talk with us, the Living Trust. You can ask a lot of questions during this section. And the next Wednesday, Global Business Council present you the number 10 country, last country this year will present you the miserable Peru, emerging real estate market in South America. Come to exploring with us, Peru, beautiful country. And you will see the beautiful video we present you at 10:50. And of course, don't forget this Thursday, 9 a.m., we want to meet you together for NAR report, and also keep you informed and stay with us, and let Education Committee serve you better and better. Thank you all joining today's meeting. Thank you, Mario. Thank you, Sylvia, for nice moderating. Okay, thank you, everyone. The meeting is adjourned. Everybody stay safe. See you soon. Bye-bye.